banking industry has not been able to get any respite from bad loans. The stressed assets in the system has touched nearly 5.3 trillion rupees or 6% of total loans. That may not sound alarming compared to global banks, but the expectation is that going forward, Indian banks can see their bad loans touching the highest level in 14 years. So is a crisis looming large for Indian banks, and what can RBI do to stem the rot? To discuss this and more, I have with me Mr. Mundra, Deputy Governor, Reserve Bank of India. Thank you, Mr. Mundra, for speaking to ET Now. My first question to you is, are we staring at a second round of NPA crisis, this time from the restructured accounts?
Let's first put it like this. I don't think in the recent past there was even a first round of crisis as such. There had been concern, and I agree. If we look at the few recent data points, so the results which are announced by the bank for the quarter ended March 2015, I would say is a mixed kind of thing. Clearly, there are banks where the pace of accretion to NPA, it is certainly decelerated. But there are banks where this trend is not so much visible. So that is the one point. The second part of the stressed assets, which we are talking about, the restructured assets. Again, if we look at the data point for March 2015, obviously the quantum of restructuring in this quarter is significantly higher than either it was in the previous quarter or the corresponding quarter. But that was not totally unexpected by the fact that the forbearance is finally over in that quarter. So if I put all these things together, I would say yes, there are concerns, there is a reason to be vigilant about it. May not be a crisis, but it would largely depend on 2-3 things. One, going forward, how the growth picks up in the economy. When there is a growth, it creates ability on the part of both borrowers and lenders to really correct the situation. The second would be on the various policy initiatives. As we know, a number of asset quality was directly related to some of the policy issues, allotments, clearances. Quite a few initiatives have been taken in that direction. Obviously, it will take some time before we see that they getting translated into a concrete action. Third important element would also be the international development. We can't be totally isolated. So what happens in the commodity prices, what happens in the oil prices, on the exchange rate front, because a number of the corporates in the country are also now exposed to the foreign currency. So I think all these things put together will determine that what will be the course of action from now.
Well, bankers say nearly 30% of restructured accounts will fall into NPA, have already fallen into NPA. Do you think this is an underestimate, or do you think it will be as much as 50%?
No, I think the 30% itself is quite say elevated figures from what they used to be. You must have seen for a long time the average run rate of restructured account getting into the NPA category used to be around 14-15%. It has slightly inched up. So I think this is what the level is. But how they will pan out in the future, or what will be the because one trend is quite visible. The restructured account turning into NPA for March 2015 quarter, the quantum was much higher than what it was in the March 2014. So obviously trend was showing the elevation, but I think this is the level, and again what would happen going forward will again be dependent on all these and factors which I have just mentioned to you.
Sir, but much of the NPAs which have come is coming from this infrastructure sector. And if you remember, most of the infrastructure lending happened during the 2008-2013 period. And this was also the time the Reserve Bank relaxed its rules with regards to exposure to infrastructure borrowers. Now, IMF had raised alarms in its 2011-12 report, but it took 5-6 years for the Reserve Bank, that's now in 2015, to tighten its norms with regards to this exposure. So apart from the economy, even the regulation has not been proactive enough to help the system contain losses?
I always say hindsight is a very beautiful thing. And with the hindsight, things can always be judged in a very different perspective. But going back, if we go back to 2008, what was the global scenario, at what point of time India was sitting, and having said all, whatever we have discussed, see, infra was a sunrise sector at that point of time. It was clearly in need of the country. There was a scope for expanding infra, and infra was capable of giving a real rate of return. See, there are two situations globally. There are countries where infra is being created for the sake of creation, so that the economy's momentum remains on. Obviously, a large part of this infra may not be able to provide a real rate of return which can serve the borrowing. But in Indian condition, the infra was the need, it was capable of providing a real rate of return. So, I think that was the perspective of regulatory framework at that point of time. Is a different thing that in subsequent years quite a few unforeseen developments have taken place. Many policy related issues have come, which has resulted into time overrun in the projects. Time overrun translates into the cost overrun, and that is what we are looking at today. So, there was a certain set of circumstances when a certain regulation was evolving. There is another set of circumstances which have emerged, and obviously regulation is quite sensitive to it and moving in that direction. But so, I do not say that it would be fair to say that the regulation was not proactive.
But do you think we could have tightened a little more earlier?
I think that the Reserve Bank has been taking a fair assessment of the evolving situation, and regulations are coming at the appropriate time.
Okay. The other big leeway that you've now given to the corporates and the banks is the 525 refinancing scheme. There is a concern that this scheme masks the extent of asset quality pain in the system. I mean, CRISIL says around 80,000 crores will be refinanced this year. Do you think that this is the case, that 525 could be another way of getting out of the pain that corporates are going through?
See, I think you would also agree with you that Reserve Bank of India can be accused of a variety of things, but it cannot be accused of colluding for suppressing a problem which is very much there. So, first let us remove this notion that that there is any such intention on the part of Reserve Bank of India. Let us understand the 525 scheme in the right perspective. Number one, what we are calling as 525 is a global best practice everywhere. In fact, it is only aimed to correct a situation which was really not addressed in a right framework. See, if you have a project which is a long term project, which will be generating the cash flow over a period of say 20 or 25 years, and if the repayment of that is tried to be compressed in 8, 10 or 12 years, there is a mismatch. Now, all this could have still worked well if the economy would have been growing at double digit. Then all this, and I think the projections which were made when these projects were first conceived, that was the time when economy was almost touching the double digit growth, and so projections were reflecting that optimism, and accordingly all the cash flows were projected. Things have changed, that we all know. So, this is only now matching a realistic cash flow with a realistic repayment schedule. Now, 525 scheme is introduced with all the proper safeguards, checks and balances. Is not open that you just pick up any advance and put under 525. It is for a certain sector, it is for a certain size. There is a provision of the external experts validating the projection. So, I think it is a pragmatic step. It is addressing the root cause of the problem, and it is carrying appropriate checks and balances.
Let's come to willful defaulters. Time and again, RBI has raised voice against willful defaulters. You've already put forth a framework for recognizing fraud. But do you think banks themselves are reluctant in classifying these loan accounts as frauds? Or is the legal system coming down?
I think it is a bit of everything. Let's understand the flow. Something happens at the operating level where the account is sitting. Now, the signals which are emanating beginning, in a very initial stage, it would be difficult to distinguish between an account coming under a stress or account getting fraudulent. There's a fact of matter. So it takes some time, delay between the various layers of administration within a bank to recognize. But yes, there had been delays. There had been delays for the variety of reasons. People try that, okay, if it's possible first to try to recover, or the requirement of provisioning. So we took notice of all these ground realities, and the framework which we have put now on the recognition of the fraudulent borrowers, I think is quite a comprehensive framework. It provides the timeline, like in case of NPA there is a SMA, in this there is a category of RFA, red flag accounts, there is a timeline, within that you have to determine, then you have to either say, be clear it is a fraud or is not a fraud. If it is fraud, then move accordingly. And early warning signals, a large number of indicative items are given. Also a system is put in place that with each review of the account, you also have to look for these signals, so that if there is any tendency of any fraudulent transactions seeping into these accounts. But as I said, that framework has been put in place. There will be 3 more components to it. The second component, once the recognition has been done, for which we have provided the framework, then the law enforcement agencies should move fast, and there should be clear cohesion that which agency would be responsible for leading this investigation. Having concluded the investigation fast, the legal system should move fast and reach to a conclusion, so that the action can be taken. And finally, there would be a need for a coordination between various regulators also, because a borrower is sitting in the space of RBI, in the space of SEBI also, maybe IRDA at point of time. So I think this is how the whole framework would evolve.
According to you, ideally how much time should it take to recognizing it as a fraud and also taking legal steps and closing the case?
See, it will be, we have to be realistic about the existing legal system. Ultimately, everything has to operate within that legal system. You can make a provision of special courts, speedy trial, but still those ground realities would remain. But to my mind, with all this framework, recognition should be pretty fast. After recognition, I think 2 to 3 years, to my mind, everything should get to a logical conclusion. And when I am telling this, we should also be, there is a one kind of very prevalent, I would say, misconception. Is not necessary that every account is a fraudulent account ab initio. There may be some account which are started the relationship with the intention of, perpetrating a fraud. That is one kind of situation. But there would be many accounts which operate as a normal account. At some point of time, the intention becomes fraudulent. Once you discover the fraud, and now you try to say that the account is operating for last 10 years, so is a fraudulent since the beginning of the relationship. That is a kind of misconception we have to actually remove. We have to be clear about it.
Well, on that note, Mr. Mundra, we'll take a quick break and continue our conversation with S.S. Mundra, Deputy Governor, Reserve Bank of India. Welcome back to this wide-ranging interview with the Deputy Governor of Reserve Bank of India. Many believe that it's time that government and RBI work collectively and push banks to take decisions on cases on loan accounts which are on the brink. Do you think that, do you agree with that?
See, question is not clear to me. Number one, to believe that RBI and government are not working in coordination, that is...
No, not working in coordination, but they should collectively work together and put pressure on banks to take decisions, because currently the banks are not moving fast. That's the view that many believe, most people have. So they believe that RBI and government, because the crisis is looming large, because the problem itself is so large, that both government and RBI should just work together and force banks to take decision.
See, again I mentioned, number one, banking system is comprising of all kind of sector. There is a public sector bank, there are private sector bank, there are foreign banks. So I think as far as the remit of government is concerned, those will be the related dimension. RBI as a regulator has been putting all this framework with the same intention. The whole framework of CRILIC or JLF or the fraud recognition system or the 525, these are all designed in that direction only. But I think we should also recognize the fact that it's not only a indecision on the part of the bank. I don't say there would be instances, but there are whole lot of things which have to fall in place. If there are policy related issues, if there are clearances related issues, when all would fall in sync, only then it would be possible to move the things speedily.
Okay. So one reason why the fact that banks have not been able to control their asset quality issues is also because of lack of leadership. Currently, 4 banks do not have a chairman and managing director. 2 more are falling vacant in the next 1 month. Isn't RBI worried?
No, of course, obviously is a matter of concern, and I think Reserve Bank of India had been engaging in this matter from time to time, because this is a very, very important aspect, and in top leadership in any organization is obviously it makes is a matter of great importance. And I would rather add further is not only the top leadership or the corner room. There are issues around the middle rung leadership in public sector bank. That is also a very serious issue, that most of these people would be retiring in next couple of years, and there can be a leadership vacuum in those capacities also. So we have been expressing this earlier too. I think it's high time, because when there is a vacuum in leadership, not that the people who are sitting there they are not capable, they are taking care of day-to-day activities of the bank, but my sense is more or less it gets reduced to a maintenance function. The leadership is required for a strategic vision, for chalking out a path for next few years. Those things obviously suffer, and you may not feel the impact so much today, but its impact would be seen more tomorrow. So I think we should be concerned from that perspective. But having said that, I think some action has been, process has been put in motion. In a defined system, the processes take their own time. There are multiple level of decisions coming, observations, but the process is on.
A small point, you spoke about conserving capital, but public sector banks are in a way bound by a lot of constraints. On one hand, they don't receive capital from the government. On the other hand, they are not able to raise capital, equity capital from the market. And thirdly, they are expected to pay dividends to the government. Now, how can public sector banks function within such constraints?
Right. So I see the other 2 elements I dealt with while I was replying to your previous question. That exactly is the point. If these are all the situation, I think they should retain as much profit they can retain, so that it gives a capital support. So in this environment, I think it doesn't make a very great policy to pay higher dividend when they are in need of capital, and it would do better for them to retain these profits and augment their capital.
And that too when their profitability is falling quarter on quarter. Coming to policy transmission, 21 out of 91 banks have passed on the rate cut that even after much prodding from the RBI. What has gone wrong? Why do you think banks have been slow and soft in passing on this rate cut? Do you think the problem lies with calculation of base rate itself?
I think the lending rate or base rate of the banks and transmission of monetary policy has been a matter of discussion in the Indian financial system for quite some time. A number of committees have also looked into it. Actually, these are, it's a very combination of some of the structural issues also, and what is the composition of balance sheet of the banks. Now, banks, the composition of the balance sheet, the largest source of resources for banks is the deposits. And in Indian system, the deposits are generally fixed rate deposits. So till they come for maturity, the sensitivity of banks to change with the change in policy rate is really not very directly linked. So those larger issues are there. Having said that, there are the issues around how the base rate is calculated. There had been some lack of transparency in some cases. Various benchmark kind of things are utilized. I think having taken a note of all these factors, Reserve Bank had indicated in the last monetary policy announcement that will gradually would like the banks to move towards the marginal cost of funding in deciding the base rate, and probably that would be a better vehicle for the transmission of monetary policy.
But banks have been vehemently opposing this.
Yes, there had been. See, it's a very interesting situation. There are banks which are vehemently opposing. There are good number of banks and large banks which have been operating with the marginal costing for quite some time, and they express the view that they are quite comfortable with it and they find it truly representative of the change which should happen. So it's a mixed bag. We have given a kind of broad framework. We are listening to the banks whatever they are mentioning, and we are working on this to finalize the.
But this will be the way that banks will base rate will look like in the coming days.
As I said, we are taking all the feedback, but largely yes, this will be the direction. See, the final direction should be ultimately the rate should get linked to a market benchmark.
The other problem with base rate is in the kind of distortions. A lot of, for instance, the farm loans. Farm loans are given at 7%, which is much below the base rate. Do you think such distortions in pricing should be removed and that the government should just transfer the subsidies directly to the beneficiary's account?
I would say we have come a long way from what it used to be few years back. Well, practically the whole interest rate structure was administered. Now, see, barring 2 or 3 elements, I think interest rate structure is completely liberated. One is of course the what you have mentioned. Other thing, it also to a large extent get influenced by the various small saving schemes. They also at times work as a kind of floor. But yes, on this we have been of this opinion quite clearly that if there are any benefits, interest subvention is not a very efficient mechanism of achieving those purpose, and somewhere it also affects the monetary policy transmission. So we have expressed that viewpoint clearly to Government of India that whatever is this kind of support is to be given, it should be done by way of a direct benefit transfer.
Do you expect to see some action on this front?
Let's hope so. Normally when RBI is making some viewpoint, government has been quite receptive and serious to examine it. So I'm sure they would certainly be looking into it quite.
Well, let's look at the way forward. The Reserve Bank will soon announce licenses for both small finance and payments bank. There will also be licenses on tap going forward. What do you think in the next 5 years will drive the banking sector forward? More banks or consolidation?
See, these things never are kind of unidirectional. My sense is there may be a mix of both. Because see, consolidation in any mature or dynamic market happens because of the emerging needs and the chemistry and the dynamics of various organizations. But if consolidation is happening somewhere, it does not mean that the new player will not come. So my sense is it will be a much more interesting marketplace which will be functioning few years from now. Various kind of banks would be operating. Some of them will be in niche segment, some of them would have a different kind of capabilities, and at the same time if synergy drives, there can be consolidation also. And yes, there is a room and a scope for some large entities also to emerge. So I think it will be a bit of everything which will be there in the market.
Then Mr. Mundra, thank you so much for talking to ET Now.
Always welcome.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at @etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.